Okay, so let's unpack this. When you think about protection policies, life insurance, critical illness cover, that kind of thing, your focus as a client is almost always on two things.
Right. The monthly premium and the final payout.
Exactly. But there's this really complex and crucial process happening behind the scenes long before those numbers are even finalized.
And that process is underwriting.
Underwrite.
It's truly the backbone of the entire protection landscape. You might be focused on the benefit, but underwriting determines if the policy is offered at all.
And on what terms, I imagine.
And critically, on what terms.
Okay.
Without good, methodical underwriting, the market just, well, it isn't sustainable. The whole balance of risk collapses.
So our mission today is to do a deep dive into that. From the insurer's perspective, we've pulled out the key bits that explain how they assess your unique risks. Why they ask all those intensely personal questions. It's basically your shortcut to understanding why your policy costs what it does.
And the stakes here are really high. The core objective is pretty simple on the surface: assess the client's risk and decide if it's acceptable for the insurer. But it's a delicate balance.
How so?
Well, if insurers take on too much hidden risk, the claims that follow will drive up premiums for everyone. But if they're too restrictive, good clients get unfairly declined. Good underwriting is really the guardrail that ensures risk is shared responsibly.
And that journey starts with what feels like a mountain of paperwork, or I guess a digital form these days. Which brings us to our first section, the foundation of trust.
Right. Why disclosure is everything. And you can't overstate this. The relationship starts with transparency. The underwriter makes decisions based only on the information they get on that form.
And it's a pretty detailed form.
Oh, it's comprehensive. It covers your medical history, lifestyle, job, family health, any hazardous hobbies, and your finances.
And I think people are sometimes tempted to streamline their history a bit. They think, oh, that back pain I had 3 years ago, it's gone now. I'll just leave it out.
Yeah.
What happens then?
That's where it gets incredibly dangerous. Non-disclosure, even if you just forgot something, can void the policy when a claim is filed down the line.
So it could all be for nothing.
Imagine filing a claim for a heart condition 10 years from now, and the insurer finds out you didn't mention a hypertension diagnosis from before the policy started.
Okay.
If the underwriter can say they wouldn't have offered the policy on those terms or at all had they known, the claim can be rejected.
So it's not just about active lying. It's about being complete.
Precisely. Honesty and detail are mandatory. There's no advantage in hiding anything. They will verify the information at the claim stage.
Okay, so once all that information is in, the underwriter translates it into what?
A decision.
Into one of 5 possible initial outcomes.
What are they?
First, and best, is acceptance on standard terms. That means your average risk for your age and the price is what you were quoted.
Second, you might get a loading. That's an increased premium. Third, an exclusion, which removes a specific condition from your cover.
And the last 2.
A postponement, where they delay the decision for, say, 6 months for a condition to stabilize. And finally, in the rarest cases, a decline.
And getting to one of those outcomes is based on what we're calling the 4 pillars of risk assessment. Let's dive into those, starting with medical underwriting.
Yeah, and what's fascinating here is that Pillar 1, the medical side, is often the most complex. It relies on centuries of actuarial data. This isn't just guesswork.
It's data-driven, so they're not looking at your health in a vacuum. They're comparing you to thousands of other cases.
Exactly. They're looking at the diagnosis, its severity, when it started, and crucially, how well you're controlling it. We're talking about things like type 1 versus controlled type 2 diabetes, or a history of cancer. Each one has its own underwriting guide.
Can you give us a real-world example? Let's stick with diabetes. How does that work?
Sure. For someone with, say, very well-controlled type 2 diabetes, managed just with diet and exercise, the risk might only require a small loading, maybe a 50% increase on the premium.
Okay, that seems manageable.
But for poorly controlled type 1 diabetes, with complications like neuropathy or something similar, the statistical risk jumps. That could lead to a loading of 200%, maybe even 300%.
Wow.
The loading is just the financial reflection of the expected future claims for that group.
And what about exclusions? When do they use those instead?
An exclusion is for a very specific, localized risk. Let's say you had a severe spinal disc issue years ago, but it's fully resolved.
Right.
The underwriter might just exclude any future claims related to your spine rather than loading the entire premium. The goal is to give you as much cover as possible.
Okay, that makes sense. Let's move on from health to Pillar 2, occupational underwriting. So this is about what you do for a living.
And it's a completely different type of risk. Here, the underwriter is looking at physical danger. Do you work at heights with heavy machinery?
Or in hazardous environments, like an offshore oil rig.
Exactly. They even look at stress and burnout risk now, especially for high-pressure jobs.
The difference between an accountant and, say, a scaffolder is pretty obvious. But what about the less obvious risks?
Well, those subtle risks are statistically measurable, especially for income protection policies. For IP, the job itself dictates the likelihood of you being unable to work.
So a construction worker is just statistically more likely to get injured than a digital marketer.
Right. So for that higher occupational risk, the benefit they offer might be a lower percentage of your income, and the premium will be higher.
That tracks. Okay, pillar 3. This is where we leave the workplace and look at how you live your life. Lifestyle underwriting.
And this is one of the areas clients challenge the most. It covers smoking, alcohol, drug use, high-risk hobbies.
A big one is smoking, isn't it?
It is. The standout fact is that smokers, and it doesn't matter if it's 1 cigarette a day or 20, are almost always in a higher risk category.
And that includes vaping now, too, right? Nicotine patches.
Generally, yes. Any nicotine use. The data just shows higher mortality and morbidity risks. The premium difference for life insurance can be double, even triple the cost.
That feels a bit harsh for someone who's just a social smoker.
Well, the problem is that it's impossible to verify the quantity of occasional use over a 30-year policy, so they have to draw a clean line for consistency.
Nicotine user or non-user. Simple as that.
Pretty much.
And what about high-risk hobbies? Skydiving? Mountaineering? If you're an active person, do you get penalized?
You're not penalized, but the risk has to be priced. For things like technical scuba diving or private aviation, they need to know the frequency, the depth, the altitude. They'll often add a specific exclusion for that activity. So if you die doing it, the policy won't pay out.
But I imagine there's some room for nuance there.
Oh, definitely. A certified expert with thousands of controlled dives will be treated differently than a total novice. But that means you need to provide detailed evidence.
Right. Which brings us to our final pillar, number 4. Financial underwriting. This sounds a bit dry, but it's key for preventing something called moral hazard.
Moral hazard is a core concept. It's the risk that having insurance makes you less careful, or worse, creates an incentive for the insured event to happen.
So if I earn $50,000 a year, but I try to insure myself for $5 million, that's a massive red flag.
A massive red flag, exactly. If the payout is way more than the legitimate financial loss, it suggests the policy is for speculative, maybe even fraudulent reasons. Financial underwriting just makes sure the cover level matches your actual needs.
And for income protection, how does that work?
For IP, the benefit is always capped, usually around 50 to 65% of your pre-tax earnings.
And that's deliberate.
It's a necessary constraint. If you're better off financially on a claim than you are working, you lose the incentive to go back to work. The cap maintains that incentive.
So that whole systematic analysis, medical, occupational, lifestyle, financial, that's a lot of data. How does the underwriter actually pull it all together? Which leads us to section 3.
The path to a decision. Well, their toolkit is pretty sophisticated. They have their own underwriting manuals, specialist guidelines, huge actuarial data systems, and very often, they need to get more information. This is usually when clients start to get nervous.
Yeah, that moment the insurer asks for a report from your GP or for a blood test, you immediately assume you're about to be declined.
And that's why an advisor's communication is so vital here. These requests are routine, especially for larger policies or complex histories.
So it's not a red light.
Not at all. It's the opposite. It's a sign they're trying to make an accurate decision. A GP report might take weeks, but it could be the thing that confirms your condition is stable and gets you standard rates instead of a loading.
So the delay can actually be in your favor.
Absolutely. And for many people, the process is simplified by something called non-medical limits.
How do they work?
It's a set level of cover, say 500,000 pounds of life cover, that can be issued without any medical evidence as long as you have a clean application. It's for straightforward cases.
But if you go over that limit,
the moment you go over that threshold, or if you have any medical history, the medical underwriting becomes compulsory.
So once that final decision comes, back standard, loaded, excluded, the advisor has to step in and sometimes deliver what might be bad news.
And that takes real skill. You have to help clients interpret it logically. If someone gets a 75% loading, their first reaction is frustration.
About the cost, yeah.
But the advisor has to stress that they are still getting valuable protection they wouldn't have had otherwise. Underwriting is about managing shared risk fairly for everyone.
Which brings us to our last section, the future of risk and claims.
Mm.
Because underwriting's job isn't done once the policy starts, is it?
Not at all. There is a direct line. Thorough, transparent underwriting leads to straightforward claims. If the insurer had all the facts up front, they can't challenge the policy later.
But if something was left out,
Non-disclosure is still the #1 cause of disputes when a claim is made.
and I guess technology is making it easier than ever to verify things.
That's right. Insurers are increasingly using digital tools, prescription databases, automated systems, all to verify information at the application and claim stage. Full disclosure protects you.
And here's where it gets really interesting looking forward. Technology is changing how risk is assessed, isn't it? Moving us away from those broad categories.
Oh, it's a massive shift. We're seeing more automation, predictive modeling, instant decision engines. We can get straight through processing for maybe 60–70% of standard applications now.
Wow.
But the real game changer is personalized underwriting.
Tell me more about that. How personal are we talking?
We're moving toward dynamic risk assessment. So instead of just categorizing you as, say, male, 45, high blood pressure,
Right.
future underwriting might use deep data streams. Imagine a system that sees your medication compliance from refill data, your activity levels from a wearable, your real-time biometrics. It allows for personalized pricing, where your premium reflects your individual behavior, not just the static data for your group.
That sounds incredibly precise.
Yeah.
But also a little unsettling. The lines start to blur.
They absolutely do. If you can prove with data that your risk is lower than the average person with your condition, you could get a much lower premium. It's efficient, but it does force us to rethink the whole idea of shared risk.
Which brings us full circle.
Yeah.
Underwriting is vital. It keeps the system stable, keeps premiums affordable, and makes sure claims get paid fairly. And communication is clearly key to navigating it all.
And this raises an important question for you, the listener, to think about. If underwriting is becoming more and more personalized, relying on digital and behavioral data to reflect your specific individual risk, what does that ultimately mean for the fundamental concept of shared risk in the future? And how will this technology change the definition of an acceptable risk for the average person?
Something to ponder as the digital future of insurance unfolds.